This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. The particulars contained herewithin were obtained from sources we believe to be reliable but are not guaranteed by us and may be incomplete. The opinions expressed are based upon our analysis and interpretation of these particulars and are not to be construed as solicitation or offer to buy or sell the securities mentioned herein. The opinions expressed do not necessarily reflect those of National Bank Financial.
Well, Happy New Year.
Happy New Year.
Can you believe we're here?
Another year just gone by.
Another year just flew right by, so we'd like to welcome you to our 2025 first podcast of the year. So definitely going to be an interesting year, but before we go, dive into our presentation here, I'd like to wish each and every one of you a very happy New Year. We hope you had a great holiday season. And may 2021 be filled with some great times, loving relationships with your family and your loved ones. And certainly, as we all get a couple years older, we wish you the greatest of health in 2025. 2025 also, it's hard to believe, but it marks a special year for me. Started in the business in 1985, so this is my 40th year in the business. A few more to go. You can't get rid of me that fast, but
no
certainly it's been a great ride.
40 years. Huh?
40 years. And
crazy.
I think what's really, truly important about that is the loyalty that we've had from each and every one of you over the last 40 years, the trust that you've instilled in us, which we take very seriously. We are going to try our utmost, like we always do, to deliver on our value proposition, which is always to deliver you superior risk-adjusted returns. And that's exactly what we're going to try to do for you in 2025. So we're going to mix it up a little bit today. Normally I go first with the economic outlook, and Cody follows it up with an update on our mandates, but Cody's going to switch it around. Cody's going to talk about 2024, what that year looked like for the markets and Verus Financial, and then he'll turn it over to me, and I'll give you our Verus outlook for 2025.
Great.
Here you go, Cody.
Awesome. Alrighty, so we're going to start with, as we obviously head into 2025, it's always very important to reflect on the year previous.
Absolutely.
And so if I'd like to just give a quick rundown of what happened in 2024. I'm going to keep it relatively short because we have had multiple podcasts throughout the year. I think you know what's been transpiring, our thoughts. They've been well articulated in both the podcast, wealth notes, and a plethora of other things. So I'm going to keep it short, but first and foremost, I always like to start by going back in time and looking as to what was the expectation in the beginning of 2024 and what was Wall Street saying at that point in time. And so what's funny is all these targets are always released at the beginning of the year. They just came out.
Just a plethora of every firm just jumps on the bandwagon and we're inundated.
You're inundated. And it takes news headlines saying that this year is going to be another stellar year. But the funny thing is, nobody ever goes back to look at what actually were those forecasts and what was the miss on a lot of Wall Street's expectations. So we did a little bit of the work for you.
We'd love to do that work.
So it's interesting if we looked back to the beginning of the year as basically in December, all of Wall Street, the major banks, investment firms put out their expectations on where usually the S&P 500, the U.S. market, is going to finish for that year. And if we look back at the price targets as listed up on the screen here, you can see that in the beginning of January, December 2023, basically the majority of investment firms and analysts had a price target on the S&P 500 that was flat. The average was actually down 20 basis points.
Yeah.
Okay. You had some lower numbers. You take a look at Morgan Stanley. Their assumption was the S&P 500 was going to finish at 4,500 points.
Yep.
And so a lot of that, I think, pessimism, and we can define it as that, because that's definitely not an optimistic outlook with the market being flat. That after the hot year of 2023, there were still a lot of concerns out there. Would inflation
Would we enter a recession?
Would we enter a recession? Is the soft landing achievable with peak policy rates? Things that we have discussed, obviously, at length in our podcasts. But what is funny is we take a look at all of those expectations and targets that were set, and now we fast forward and we have the result. With the average being basically flat for the year, the S&P 500 delivered a 23.31% rate of return for 2024.
Yet another year of dismal forecasting, which I always love to say the consensus view is usually always wrong.
Yeah, and it just goes to show you that a lot of these forecasts, just use blunt language, are garbage.
And they get paid, and they get
paid big bucks, and everybody
bucks.
buys into the hype as we've seen just recently with all the forecasts coming out. But you can see that each of the investment firms, the miss on all of their projections for the S&P 500. So the average miss was off by 24%.
Huge.
So kind of tough pill to swallow. And Ken's going to touch on in his later slides is we take these exact same names and sure, they missed this year, but what are they expecting in 2025? So they got it dead wrong.
Yeah, we'll have fun with their new targets.
And we'll see what happens there. Ken's going to go through it. But what we always like to do as well, and the benefit of us having these podcasts, putting them online, is it's all recorded. It's always there.
Can't hide from it.
So it's nice, and we did this, Ken and I did an exercise where we go back and look at exactly what we said. So we had a podcast on January 11th of 2024 where we outlined what was our thoughts on what lied ahead for 2024. And so there was a couple key elements, and I just pinpointed them. The podcast is there. It's actually January 10th. Sorry, not the 11th, off by one day.
Good thing we didn't wear the same outfits.
I know. I always have to go to my closet to make sure I'm wearing...
What did I wear last time?
Exactly.
There we go.
But 5 key things that we mentioned, and this was our expectation, and it's littered throughout this long podcast. But the first point was we were remaining cautiously optimistic for 2024, and our investment strategy was to remain neutral, a little bit of profit taking, and mainly just putting our mandates back to essentially the long-term strategic weights.
Yep.
Okay. We were under the impression that there was going to be a mild recession in Canada. We were wrong on that.
So close,
but very close.
So
very close. And we'll admit when we're wrong. There's plenty of things that we do get wrong.
Didn't miss by much.
We did get that wrong. And then we also said the U.S. may achieve a soft landing. That has definitely
been the case.
We also said that inflation would be brought under control and there would be deeper and faster cuts in Canada than the United States.
Cha-ching.
I'm
going to go through it. Right.
Number 4, we said that we were going to anticipate lower rates of return than we saw in 2023. In 2023. And we said, you know what, still remaining cautiously optimistic that this would be in the mid to high single digit range.
Yep.
Okay. And number 5, we still expected there to be growth in a market rally, but specifically a little bit of broadening. But most importantly, we also said...
Which only happened in the third quarter.
Only happened in the third quarter. But we also said that the Mag 7 would continue its performance.
Yeah.
So, what transpired?
Not bad.
Not bad.
Better than, Wall Street.
Quick little recap of exactly what transpired, even though I just listed the S&P 500. Sum up 2024 in literally 3 charts. Number 1, why was the year turned out actually good? A main reason for that is growth in the United States exceeded expectations. And if it exceeds expectations, there was a rise in corporate profitability. That was fantastic. And also, what really helped the case was inflation coming down substantially. You take a look at the United States and both Canada, those peak levels of inflation
from 9 to 2.5, 2
were eradicated. Cha-ching on exactly what we said. And another cha-ching quickly was exactly what we said right at the beginning, and we were very vocal about this throughout the course of 2024, was there would be steeper cuts in Canada, and that is exactly what transpired. And right now we have one of the largest actually rate spreads between the Federal Reserve and the Bank of Canada right now.
Yep.
And so all those 3 elements, larger growth in the United States, we had inflation coming down, and also rate cuts, spurred what was a very good 2024.
Even with peak policy rates.
Even with peak policy rates. So we take a look at the S&P TSX, up basically 18% for the year. Fantastic.
Big surprise.
Big surprise. Even though we held our weight there.
Yeah, we did.
And diligent, especially, and again, going back to the podcast, we talked about Canada cutting rates deeper. And what does that do for dividend stocks?
Makes them more attractive.
Makes them more attractive, and we saw the result there. S&P 500 up 23, as we've already said. The Dow up basically 13. The NASDAQ, again, rallying. The tech names, the Magnificent Seven. NASDAQ up 28%. Russell, bumpy year for the Russell.
Very.
Very, very bumpy. Up, still solid number, up 10% almost. An area of weakness was international markets.
European markets.
Nowhere to hide. Basically flat for the year, up 1.15. And then the Canadian bond index really benefited from those more dramatic rate cuts, up 4.23%.
Yep.
So overall, 2024, based on the pessimistic views of the street,
worked out pretty good.
Turned out very well. So just quickly, I'm not going to go through this. These are always just slides I like to include because a lot of clients do like them, that give a breakdown of both the Toronto Stock Exchange and the S&P 500 in terms of the leading contributors, the leading detractors for the year, and then also the attribution per sector. So how did each sector within the Toronto Stock Exchange and the S&P 500 perform? So you can kind of see across the board, pretty good for the Canadian marketplace, okay? Especially with financial services being up 30% and it accounting for the largest portion of the Toronto Stock Exchange. It was a good year. Besides the one pain point that has been a pain point for, I would say, the last 2 years, communication services.
Yeah, like for at least coming up 3 years, but I would certainly be devil's advocate on that and look to that turn, because as we get further rate cuts, those high yielding communication stocks are going to become more and more attractive. So
we'll see how it pans out, but BCE basically down 30% for the year.
Yeah, it's hard to believe. Rogers, TELUS, they've gone nowhere in 3 years.
That's what happens when massive amounts of debt levels, and when a dividend becomes in jeopardy because of debt repayments. That's where you start to see a little bit of depreciation in the share price. Is it really deep value at this point? Who knows? But that's just the lay of the land for the TSX and what it did for the year. Just some information for all of you. And then also just changing tune, going south of the border, S&P 500. Take a look there. Basically, almost every single sector was in the green, besides just basic materials, flat. The key story, obviously, being is if we look at the leading contributors of the S&P 500, don't want to sound like a beaten record, but NVIDIA accounting for 5.25% of the rate of return on the S&P 500.
Huge. And don't forget that, a lot of companies like Meta they're not in technology, they're in communication services. So you see why technology and communication services are up, because they have the luxury of being in the communication sector when they're really technology stocks.
So interesting to see, and it's kind of classic case. You actually remove NVIDIA from that equation.
I got a chart on that.
Yeah, and the Canadian market actually outperformed the U.S., right?
Yep.
And the Canadian market's been shunned by the wayside, but to be up close to 18% for the year, still fantastic results. So 2024 was a year that most analysts, most market gurus thought was going to be not so great of a year. Turned out the opposite way around. So I'm going to pass it over to Ken, because as much as we can give a year in review, it's more important as to what lies ahead.
Yeah. Okay. Thanks, Cody. All I can say is it's most definitely going to be a interesting year in 2025. And I think expectations are at the highest levels I've ever seen in my 40-year career. And, the kind of $1 million question is, we take a look, and we've had 1, 2, 3, 4, 5 periods where we've had, going all the way back to 1927, where we've had 2 years in a row of double-digit returns. And, it's yet to be seen what's going to happen in 2025. But when you look at that, there's 5 periods of down periods, and those down periods average 23% down, and the 2 up periods average 14. So I think, it's going to be interesting, but the expectations and the amount of money flowing into the market at record levels believe that this phenomenal rally is going to continue. But when we go back and we take a look at what's happened since 1950, you can see that the third year has been relatively flat with a minor gain of 2.1%. I also find that interesting because, it's also the first year of a presidential cycle. Usually year 1 and 2 are not the best, and year 3 and 4, like we just got, were certainly the best. This chart, and I'm a chart junkie, as you know, absolutely blows my mind. And it doesn't matter what matrix you look at from. It doesn't matter whether it's PE, and that's the first one's last 12 months. The next one's the next 12 months. The cap ratio, I'm not going to go through all of them, is the amount of money that banks have on hand for their riskier assets. But I'd focus on where it says the last right-hand column, where it says percentile since 2000, the 70s, and the 50s, the go-go years. And take a look. Isn't it mind-boggling that almost every single financial ratio that you see there is almost close enough to 100%? And to me, that's a sense of euphoria. That's a sense why there's so much money going into the market. That's why, so many people are certainly optimistic. But that one chart simply says that valuations are at extreme levels. Cody shared with you like the top analysts on the street and their forecasts. I'll share their forecast for 2025, but you really do have to look deep, hard, and under the hood to find an analyst that is pessimistic or that is bearish. So there's a strategist at BCA. He's the chief strategist, and He believes that the consumer spending's rolling over. You've got full-time employment growth going the wrong way. You've got bankruptcies last year, over 500,000, a 16% increase since the pandemic.
Yep.
You have, 10-year bond yields,
Still surging. Yep.
Surging on the rise. And what he noted in an article recently is that he pointed out that in Trump's first 4 years, the forward PE was 17 times. And based on a host of factors, he believes that forward PE is going to drop to 17 to 18 times. Who knows if he's going to be right, but if he is right, that represents a 30% drop in the S&P 500. So this is the one that I find fascinating, price to book. Even since the dot-com era, stocks on a price to book basis have never been, ever been this expensive. And in our last few podcasts, we talked about NVIDIA trading at 23 times, sales books. Like the numbers are just clearly off the charts. So again, we take a look at this, and here's the exact same chart that Cody had, but what the implied gains are going to be for 2025, with the average being just below 12%. And there's some mixed bags out there. But the reality is, if you go back 20 years to 2000 and, you look at the fact that the analysts' year-end targets in the last 24 years have missed the mark by 14%. 14%.
They're off by 23 last year, so.
Yeah. Well, better than the average.
I know. Or no, worse than the average. So,
worse than the average. The thing that I find truly fascinating is, of all the major firms, you can't find one firm, one analyst that believes the market is going to end in negative territory in 2025. Don't hold your breath on that one. So what they also get it wrong on, obviously, is the earning growth estimates, right? And, 2% there, 2% there, but these numbers actually are, very critically important.
Yes.
And if we do get a setback in consumer spending, because all the money from COVID that was saved is now spent.
And just the lag effects
The lag effects
of peak policy rates and how long that actually takes to articulate itself through is very unknown, but it also is challenging with all the stimulus that we've had, and how much is that stimulus really propping everything else up too?
Well, throw the consumer debt levels and the government debt levels into the equation on both sides of the border, and they're at absolute, complete record levels. And at some point, I've always said to you, debt becomes a problem. And if you can't grow your way out of it, then look out. Something else is going to happen. So I think these earnings estimates are certainly optimistic. But the amount of money that's gone into U.S. stocks, and we talked about this on our last podcast, is just unprecedented. The daily amount of volume and the amount of fund flows is at a pace that we've never seen in history before.
Relentless flow of capital, and that's pure momentum that is just driving you. Pile it all into usually passive vehicles. It goes directly to each single line that mimics the S&P 500, and guess who the benefactors of that are?
Yeah. I mean, we spent a lot of time talking about the record inflows of ETFs into the U.S., but we really don't, we haven't touched on Canada that much. But in Canada now, there are 1,500 ETFs. There was 224 new ETFs created last year.
Like you said, flavor of the month.
Yes.
Right? Yeah.
What I think is important to point out is that their new inflows were a record $76 billion last year in Canada. And that was a 45% increase from the previous record, which was the end of 2021. Previous record, 2021. I'm sorry, but I got to remind you about 2022. If you had a balanced portfolio of 60% equities, 40% bonds in the United States, it dropped 18.3% in 2022, the worst performance in 100 years, and that's coming off the previous record. Don't need to scare you, but those are hardcore facts that I don't think the street is telling you. Yeah. What concerns us is the amount of leverage in the market today. You've got all these new investors that think you can never lose. And, just like we saw at the financial crisis when deregulation just got annihilated, anybody that had a pulse could get a mortgage. Mm-hmm. And then all the mortgages were collateralized and sold in the deepest pockets around the world. Well, in July of 2022, the SEC, the Securities Exchange Commission in the United States, approved the use of single stock ETFs. Yeah. Those single stock ETFs are virtually all double leveraged, 2 times long.
Or triple.
Triple? Yeah. Yeah.
I'm sure you could find something more to do.
Yeah, I'm sure you could find something more than triple if you want, but
for sure.
Hold on to your hats. So, if
it's... I know the money call at that point.
Yeah. If it's 2 times leverage and it goes up 5% in one day, you got a 10% return in one day, but don't think the converse is not true. It goes down 5% in one day, you just lost 10%. So, what's mind-boggling about this now is there are actually 60 single-stock ETFs that trade on the U.S. exchanges. There's $18 billion under administration. Yep. And what do you think the single largest single-stock ETF is? It accounts for $6 billion of the $18 billion.
Is it Tesla?
No,
NVIDIA.
NVIDIA.
Yeah. I thought Tesla was one of the, I think the first, Tesla was actually one of the first stocks that got approved for that single leveraged ETF.
Yeah.
Which, again, it just becomes, everything has become gamified.
Yeah,
now, in my
gamified.
opinion. It's crazy, almost like a casino.
Okay, I really want you to focus on what I'm going to say next. On January 3rd of 2023, single stock ETFs accounted for $500 million worth of volume. Fast forward, that was January 2nd, 2023. January 3rd of this year, 4 days ago. A year ago, it was 500 million. 4 days ago, January 2nd, $7.4 billion. 500 million to 7.4 billion. What does that tell us? That the craziness is rapid. It's happening to kick off the start of the year, which I think is obviously going to be pretty challenging. You talk about
Who needs 152% for NVIDIA? We need to triple that, right?
Yeah, exactly. And why not leverage the house, or better still,
exactly. Take out a mortgage,
better
throw it
still,
all in.
I got the millennials, leverage your parents.
Yeah, exactly. Borrow from mom and dad.
Yeah, borrow from mom and dad, the virtual ATM machines. Hey, mama, I got this great idea, and I'll cut you in on half the profits. Not a problem. Right. So let's triple leverage these things. But I don't know, you take a look at the equal weighted and you can just see that how it's all been about the Magnificent Seven and the bottom 400 here. You take a look at that. What does that tell me if you're a contrarian like I am? Like at some point in time, the equal weighted index, like it did in the third quarter, because again here just before this, you've got the 10 top stocks. Look at that. Like never have we ever seen concentration like this in the history of the markets ever.
Narrow.
So what happened? What happened in the third quarter? Hey, the big scare was rates weren't going to come down as fast as everybody thought, and the equally weighted S&P 500 almost outperformed 2-1. I think that is going to be a trend, and the broadening of the rally, which we really didn't get that much of, other than the third quarter. I think you're going to see that continue as we move in through the year. This chart for me is absolutely mind-boggling. Look at the scope. I know it's really hard to focus on that right-hand corner, but look at the market cap as a percentage of GDP going back to 1872. What do you think of that, Code?
Yeah, looks a little scary. I'm just looking at the other peaks quickly, but
well, you can see the peak in 2000, right?
Well, first of all, we started in 1929.
Well, you can see the great crash, right?
1929.
Then you can go to the go-go years of the 70s as it goes up in here, right? You can go like where the nifty 50s were, and then you go right to the end. That's
craziness.
That's
craziness.
A crazy chart. And so now that we've had this huge concentration and, some of the greatest technology companies are in the U.S., I mean, you just look at the divergence of the fact that now the U.S. market makes up 75% of the world index. And you can see as Europe, as we alluded to, was virtually flat last year. You can see that gap, and that gap, really hasn't been that wide. But it now does exceed the nifty 50s in the early 70s. Yeah. So
complete decoupling.
Yeah, that is a complete. I mean, look at the the conformity and then the complete decoupling. Yeah. But what happens when things decouple?
Yeah, they mean revert.
The mean revert. I think you're going to see that in 2025 and beyond. What's interesting, and here's the chart I was talking about. Look what happens when you remove NVIDIA from the S&P 500. And you compare that to the world index. Yeah. That one stock is what's caused that huge divergence from the previous slide. But I find that very interesting, and look how close the performance have been if you remove that one stock. Well, you've talked about this several times before, Cody, and we take a look at where there may be some opportunities, but the Russell 2000 has never been at a steeper discount to the S&P 500.
Back to the tech bubble.
Back to the tech bubble. Boom. And I think what obviously, I think a correction could easily be on the horizon, but after whatever happens in this marketplace, that's certainly an area that I know you're focused on, definitely. Certainly looking to
add to it at an opportune time. And it's the small cap space, as I'll touch on. We had a little bit of a tough year on our small cap mandate as a whole, even though it was very choppy. But within the small cap space, there is just so many different names to choose from, so many different stories. And there are points in time, unlike you chasing, like as a Canadian manager, you're chasing 60 names. If you,
that's all you got.
You can't really deviate, unfortunately, too far from the benchmark itself. But when you have such a large opportunity set like there is in the small cap space, there is that wide dispersion sometimes between what the index does and a manager does, right? And so I'll touch on that when it comes to it. But holistically speaking, if we look at small to mid cap companies in the United States, the valuation is there. But the problem is, and this is why I think you were mentioning the timing aspect of it is if there does become some sort of distress throughout this year, all equities, regardless of size, regardless of geography, correlation goes basically to 1 and everything moves down. Regardless if you're owning the safe utility or the tech stock, you're still going to see some slippage.
Yeah.
Right? So it's still having exposure and diversification to that area, but when is the opportune time to add? That's something that only time is really going to tell us.
Probably not today, but the opportunity is there. And why that gives us such an opportunity, and the reason why I know you're excited about it is, as Cody just alluded to, everybody in Canada is chasing the same 60 names. There's only 252 stocks on the Toronto Stock Exchange, and every manager's chasing the same 60. How do you add value?
Yeah.
Very, very, very difficult. So the likelihood of a recession. Well, people were calling for it quite aggressively in 2023.
Yep. Never
happened. Is the soft landing achievable? Don't know. It's only happened once since in 1994 and 1995. But the reality is if the consumer continues to become tapped, consumer spending rolls over, and it appears that rates in the U.S. are going to be more restrictive, I don't think you can rule out a recession. I don't know. Tough thing to predict. What would I put the odds on? Maybe 50-50. There's a lot of people talking about stagflation. Don't really see that in the cards. Maybe there's a 15% chance, but if we do enter into a recessionary period with valuations the way that they are, that doesn't sound like a
pretty picture,
a very good recipe to me. So this is basically the cycle of investors' emotion, and I just bring this up because the reality is, if every chart that I think we've tried to show you and to demonstrate, in my mind, for sure, we are at the top of euphoria. This market is priced to perfection.
It's expensive.
And it is riddled with investors that have high levels of confidence and that are definitely not fearful of any risk. Mm-hmm. It kind of reminds me when we go back, and I just wanted to say one thing about the forecasting is, because I just thought about it, is that, and how difficult it is. Like in 2022, that devastating year, Michael Wilson from Morgan Stanley got it bang on.
Yeah.
Okay. But then in 2023, he thought the bear market was going to continue, that the risk reward profile of the market was not good. He had a target on the S&P of 3,900, closed out at 4,770, and he missed the target by 22%. So are we there? Nobody knows for sure, but there's a lot of reasons why it certainly looks like that. You go back to 2000. What was it all about?
The internet.
The internet.
Yeah. And
you had this levels of peak expectations. Do you see any similarity code between the internet and AI today?
Very much. Very overhyped in the short term, but
and it will be a technology like the internet of the future. But the $1 million question is, at what price and at what valuation?
Exactly.
And I think we're right there, close enough to the peak. Not that we want to go back to 1718 and talk about, the great investor, scientist, school teacher. This man invented virtually everything, Isaac Newman. But the reality is this reminds me a lot, but it doesn't have to be South Sea stock. It could be Nortel. Yep. It could be Exxon. It could be Valiant Pharmaceutical. But the reality is that as you climb that, Newton invests a bit, he exits happy, his friends all talk about it. It's like you and I talked about several times. When we're doomed, when the cab driver is telling you how good the stock market's going to be, right?
Yeah.
So Newton re-enters with a lot of money, and then what happens in the case of Nortel, what happens in the case of Exxon, what happens in Valiant Pharmaceutical, we get this bust situation. I want to leave you with one final thought. And I know that my mature clients, like myself, have all heard of Sir John Templeton. When I started in 1985, he was a legend. Mm-hmm. But now that it's Franklin Templeton, I don't think there's a lot of investors that really know how wise this man is, because everybody wants to talk about Warren Buffett, and we always hear Warren Buffett quotes. We use Warren Buffett quotes. But this quote I find fascinating. Bull markets are born on pessimism. They grow on skepticism. They mature on optimism, and they die on euphoria. Mm-hmm. And if I had to take my best guess after 40 years of managing money, that one final thought is, I think we're in a sense of euphoria. Well, it's not the greatest way to end it, but you know what?
It's okay.
You have to be able to look under the hood, look at what other people are not looking at. The contrarian view is usually wrong. And I think there are reasons today why you need to be cautious. And I think Cody's done an amazing job of taking risk off the table of your portfolios. Your portfolios are incredibly well balanced. They are not even close to being correlated to the, 100%
to the U.S. market.
To the U.S. market.
Or any specific stock market for that matter.
So as pessimistic as my view might sound, it's reality for what I believe, and I know I say it bolder than Cody's willing to say it. But I can tell you that we're going to do our utmost to deliver superior risk-adjusted returns in 2025. And Cody has you positioned for safety, but also if we're wrong, and there's always a chance we're wrong, is that your portfolios will still participate.
Of course. The purpose of diversification.
Absolutely.
Yeah. Perfect.
Well,
okay. I need that clicker.
You do?
Yeah.
Okay.
Thank you.
All right.
So quickly, I'm going to give, we touched on a review of the markets holistically for 2024, but I just want to take some time to step into the mandates themselves so everybody has a complete review as to what was the return for each one of our 6 mandates, from fixed income, our equity mandates, and our alternatives. So we list them all out for you here with the deemed asset class. And also below it is its associated benchmark, so you can see the return of that specific benchmark to peg it against something. So we take a look first at fixed income, the portion of your portfolio that is income generating, but it's there for capital preservation. And so that mandate for 2024 was a little bit of a bumpy year, but with our positioning being mainly to Canadian fixed income, Canadian bonds, we were a really big benefactor compared to U.S. bond investors, which didn't really see anything happen. So the mandate was up 4.87% versus the benchmark at 4.23. So a pretty good outperformance on the fixed income side there. We take a look at high income Canadian equity. If you actually watch that podcast from last year, exactly at this point in time, we were very vocal on holding our exposure to Canadian equity.
And we took a lot of heat. We had several clients saying, get me completely out of Canada. And we stayed true to our conviction.
Stay true to our conviction. And just as interest rates were coming down, dividends become more attractive. There was also a large outflow of foreign capital that was also, from a liquidity standpoint, suppressing the Canadian market. But as we've seen, we saw a little bit of reversion back, and our high income mandate was actually the best performing equity mandate out of mandate overall for 2024. So it was up 23%, 23.5%, and outperformed the Toronto Stock Exchange. On the U.S. side, some pretty good results. So Veris U.S. focused growth orientated, mainly those technology companies. It did 17% for the year. The S&P 500 did 25. This is total rate of return, so it includes dividends, even though we're not chasing dividends in this portfolio. But again, if you remove the NVIDIA, very much kind of close and in line.
And I think for all of you that are watching this, you have to understand that it's unrealistic for a manager to beat their benchmark every single year. And the reason why we're slightly under, the reality is because we didn't own NVIDIA.
Yeah, Poland Capital doesn't believe in NVIDIA. We've been through this in multiple podcasts as to the reason why. And just from a risk standpoint, again, all of these mandates hold individual securities from an equity standpoint.
Yeah.
Right? And so when we look at that and we understand the rationale from Poland's perspective as to why they don't own NVIDIA, you've presented multiple points as to the valuation. With that kind of peak euphoria phase and the pessimistic outlook that you've given, we actually feel very comfortable not holding a name like that.
Yeah.
If we were to go into something like that. So
I think because you could go from underperformance to outperformance in a nanosecond. And I think what our clients and what investors need to understand in U.S. focused growth is in 2023, it did north of 40.
It did, yeah, exactly.
Like 42%. And so now you're up 60% in 2 years. It really doesn't get too much better than that. And by the way, you're all in King Kong US dollars.
Totally. The same thing, I'll touch on international now. I'll go back to small cap, but international, just as we talked about the international markets, pretty big weak point overall for any investor in that space. Hasn't been pleasant. The mandate did in 2023, 30%.
Outperformed the benchmark 2-1.
Again, the podcast, don't want to sound like a beaten record. At the beginning of this year, we rebalanced, we took profits from that space, and we also started to underweight that strategy overall very early into 2024 in terms of our overall equity mix. So good timing on the trim because this year, slight underperformance against the benchmark, but it's just been a tough place for European and international equities. We take a look at small cap, okay? And this is the point that when we were mentioning the valuation in small cap, very difficult space because there's so many different names out there, but things can change in a nanosecond in that space, right? So we were basically flat for the year in that mandate, but we'll see as time progresses here. We're in contact with Crimson Asset Management on a regular basis, talk to Ken Jasudian, who's the lead portfolio manager there, hearing some interesting stories coming out of the individual names that he's holding, and we're very hopeful that over the course of the next year to 3 years, potentially that we're going to get definitely a large turnaround in some of those names. It takes a while sometimes for high conviction ideas to play out, especially in a small cap mandate where sometimes not the end goal is necessarily to get capital appreciation just in terms of the public markets. And what most clients need to think about is part of the small cap play is actually mergers and acquisitions.
Yeah.
in terms of these smaller names being bought out by larger companies at substantial valuations. And that's why sometimes you'll see in the mandate, when there becomes news that there is going to be an acquisition in nature, you can see an individual stock within that portfolio jump, sometimes 20, 30% in one day, right? So very volatile. It's definitely one of our higher risk mandates, just because small caps are of that nature. They have the most level of volatility if we look back to 1950, but historically they have generated the highest level of return, and we're still confident in that mandate moving forward. Is it the right time to be adding to it? Again, probably not right now, but if there becomes a point in time, which we have some ideas on what that looks like, we'll definitely be vocalizing that in a podcast and articulating when we add to that position.
And what we've clearly seen in that mandate is that when some of Ken Jasudian's convictions come to reality, that mandate turns on a dime.
It does.
And some of the gains have been astronomical when it turns. And last year, 30%?
Yep. Actually, it was a 20.
20 in the...
Focus growth 40, international 30. Small cap 20. So still had a phenomenal year, and we'll see how that plays out. Then the last mandate that had a little bit of an uptick in the last little bit here because real estate started to bottom, private real estate specifically, with rates normalizing here. Our alternative strategy was up 3.14 for the year, completely uncorrelated to traditional stocks. So December was actually kind of a tough month.
Yeah.
Okay. That mandate finished actually quite handsomely positive that month, and I expect it to definitely continue its strength, and it will shine if Ken's pessimistic views come to light.
Then this is what you're going to want to watch. This is what's going to save
the
value of your portfolio.
And also the fixed income as a whole. And also just the strategic changes that we've made. So that's the review of the mandates. You're going to be getting your performance reports coming out. All those are going to be distributed to you. And then what I wanted to really touch on next, but we've kind of already talked about it specifically with the luncheon presentation and podcast that we did, or luncheon podcast, was what is the mandate strategy moving forward? So Ken and I's working relationship has always been, and it's been very well articulated, Ken is really the top-down macroeconomic guy. He gave you his outlook. We sit down on a regular basis, probably
too much.
Too much. Calls me too many times a day.
Yeah. He doesn't like it when I call.
Yeah.
Trust me.
Close the door and turn the phone down a little bit.
Yeah.
All jokes aside, is we converse with his viewpoints. I obviously still have some vantage points as to what I think my macroeconomic view is. We hash it out, and we come to then a decision on what does that, with our overall conviction and thesis heading into the next 6 months, what does that look like in terms of our clients' portfolios? So, said it at the luncheon, I'm going to say it again. We were very proactive in the latter half of 2024 in terms of taking risk off the table. The majority of our moves have already been articulated. Yep. They are already done. So what that really comes to, and you can take a look at this top portion, it's the easiest to understand, is if we take a look at what is a balanced portfolio. Okay, yeah. So a client's balanced portfolio. We have the benchmark. Okay, so a balanced portfolio, 40% fixed income, usually 60% to equities. We have a hybrid approach in terms of what our customized benchmark is. We add an alternative segment to it, taken away from the equity. So instead of a 60-40, it's actually a 50% equity, 40% fixed income, and 10% to alternatives. Yep. Okay. So what we've done, and if we take a look at the changes that have been, and this is not exactly accurate, but this is very much close to every single person's portfolio. Okay, is very holistically speaking, is we have raised levels of cash to a target of 7.5%. We have also increased fixed income to 2.5%. Overall, reducing our long-term equity exposure by a whopping 10 percentage points.
And that is huge, considering that active managers today have less than 3.9% cash in their portfolios, which is one of the lowest levels in history.
Yeah. So we have a tactical adjustment on the portfolio right now where if some of these concerns that Ken and I have been talking to, and we do indeed actually have a weak year in front of us, we have de-risked every single one of your portfolios, taken away from the equities, added to the safer places to ensure that your hard-earned capital, your family legacies are preserved during a time of distress. But the thing that excites me and why most people says, and I'm just going to say it bluntly, sometimes people should actually rejoice at some of these corrections because it provides, if we have dry powder,
Opportunity.
it provides tremendous opportunity. And so that is the moral of the story of being very defensive, very underweight equities at this point, have a lot of cash, decent amount of fixed income. We have alts as a separate portion, which reduces our equity exposure even more, to where heading into a very volatile and unknown year of 2025, we have a lot of dry powder.
Yeah, I think that's going to pay dividends. And I think that, Cody and I are going to be making the review calls once the fees hit and we get you your net rates of returns. We'll be following up. And we obviously, one of the things I love to do is to talk to you. I'd remind you, though, is if you could please make a best effort, pour yourself a beautiful glass of wine and perhaps watch this. Because if I'm doing, you're doing 40 review calls, I'm doing 40 review calls, it really helps us with our efficiencies. If you could watch the podcast and know exactly what our view is, but we always welcome questions. So, if it's something about the portfolio mix, email Cody. I don't get as many emails these days, but please email me if you have any questions or when I call you, and you want to be devil's advocate and you say, how about this, how about that? Those are the conversations that we really love to engage in. So please feel free to reach out to us and we'll definitely get back to you.
Definitely. And so the last thing that I wanted to go through is everybody well knows our podcast is called Beyond the Noise. And it's Beyond the Noise to cut through all the crap that is out there to really focus on dive under the hood and focus on what we think is important for you to understand about how we're managing your capital. And so the one point that I want to touch on, and talking about analyst estimates, how wrong they are, this goes to show you the asset class returns from 2024 all the way to 2010. And which specific type of asset, REITs, small cap, emerging equities, commodities, large cap, high yield, domestic equities, fixed income, and cash, which were the best performing at the top for a given year and the worst performing in order.
Throw a dart
at whatever.
See where it lands.
You'll probably do better than how everybody else has been forecasting because you're missing by some odd 20%. But the moral of the story, and if we really go beyond the noise, if there becomes all the talk about economics, all the talk about different things that may come to fruition, market may rally, may not. The important thing when you have the massive amounts of wealth that our clients do is diversification. And there's an amazing quote about diversification that I think really would resonate with all of you. And so diversification is about forgoing the extraordinary to avoid the catastrophic and to accept the ordinary. As you can see, and the reason why there's that line is that shows you the asset allocation or diversification. And you can see throughout periods of time, it has never been the best, but it has never been the worst. And it has mainly been skewed to the upside. So that's why it's so important to have, and every single one of our clients, we have sat down, built you a customized asset allocation, a customized asset location strategy to be tax efficient. Because we're not smart enough, even though we have our viewpoints and we think we know, at the end of the day, we could get it wrong.
No question.
Right? And that's where you have to rely on being diversified, sticking to your discipline, having the appropriate asset allocation in place. And when there becomes points where Ken had that really nice quote, very much aligns with what I've shared with you before, is the market is a pendulum that swings from unsustainable optimism to unjustified pessimism. And we both agree that we're in that unsustainable optimism phase. And that's where we implement, as you've seen, our tactical adjustments to start skewing that asset allocation to either more defensive or aggressive. So,
It's a great chart.
It's a great chart.
And what's usually at the top, like 2023 for large cap.
You can see large caps, right? And then large caps go down, and it's...
You look 2020, small cap at the top, 2022 at the bottom.
Yeah,
so,
but then again, this is only since 2010,
I mean,
right?
if
Like you extend it
that,
to...
it's a great chart.
It's crazy. So it's just key principles like that. It's our job to educate you, keep you in line. We're your discipline. And we, as always, appreciate all the trust you place in us. It's never taken for granted. Ken and I will be following up with each and every single one of you for annual review call. And again, if you do have any questions, please, that would be a great point to answer any of them. And again, if you could watch the video beforehand,
please.
saves us a lot of time.
Okay,
Perfect.
well, thank you so much for taking the time to join us on our podcast. Wish you all the very best in 2025, and we'll most definitely be in touch.
Awesome.
Thank
Thank
very
you.
much.